Big tech did its job at keeping the market together this week. The more exciting action was what seemed to be a bond sell-off that kind of killed some of that Trump 2.0 post-election trade, that kind of rotation into the value stuff, into the lower quality things outside of tech. That's been falling flat now for 2 weeks, and given the pretty sharp turnaround in bond yields tracing back to Friday's last employment report, it looks like we've got a situation that demands some attention. Just not quite enough on the charts for me to change the risk radar, which has still been yellow for dollar, yellow for bonds. As I said yesterday, it looks like the conviction is going towards higher yields and higher dollar again. I'm just looking for a technical excuse to put the green light on the dollar and the red light back on bonds. But equities holding in, it's fine. Crypto did well too. BTC held 100K. So let's talk some bonds here. I got a couple of charts for you. Firstly, just tracing the recent move in the 10-year is kind of the first thing to understand why this gets interesting. The low for the 10-year yield is at that 4.1 on employment, which wasn't exactly some great number, but it was enough. And then we kind of put in this double bottom. That was coming into this week. And since then, every potential rally in bonds, dip in yields, has reversed, including some pretty meaty ones. There were a few moments this week, strong bond auctions, unsurprising inflation data. PPI was kind of warm, but it was mostly literally eggs. Look, I love them, but still, this is a trend that's now going back for a week and potentially has some ramifications if it keeps going, because this is not really in a lot of people's playbooks, especially when you match it with the dollar resilience, because then it starts to get really tricky for people that were arguing that the new Trump agenda was going to be very low dollar. That's part of the crypto economics that you hear a lot. But setting that aside, what's more important is that people don't really know what to do when bond yields are going up while expectations of cuts are also going up. We solidified the odds of the cut next week to 97% in Fed funds futures. I'm not sure if that number is particularly reflective at this point, given that in September we saw Jerome Powell do something the market didn't expect him to. The market was technically edging for 25 when they began the cut campaign, and he went 50. That doesn't mean that he's not going to cut. I think the odds still are very high, but given what's happening in the long bond market with yields rising here, alongside economic data inflation, that's the type of stuff that meets the data dependency definition of cooling the jets a little bit, because the economy looks good and it looks like every cut we're putting in is causing the long end of yields to reprice higher, which gets to a spot where a lot of expectations start to break, because generally people go, oh, the Fed's cutting rates, yields are going to go down. That hasn't been happening, so part of this might be the market saying he is going to go, and that's going to put a little bit more juice into the economy, but then that basically means next year is completely up for grabs, and that it could be a very tough challenge to have the economic conditions for lower interest rates, which starts to eat into some of that trade that was associated with Trump and the incoming policy regime. If you look at the curve too, which I always like to do, you see something as well, which is potential steepening again and breaking out. So here's the last chart. It's very simple. The yield curve, 10s to the 2s, making a big move. Basically, almost, not quite. It's a little bit of a slanted line because it hasn't broken out back yet. But you're getting the steepener in the bond market. You're getting yields creeping up. The dollar is not going down at all. It's not a coincidence that at the same time, the value stocks have started to slow down. The banks slowed down. Some of the higher risk stuff has slowed down, lower quality, which is why I'm thinking that crypto still looks a little bit at risk right now, despite its strength today. We'll follow up on that next week. We do have Jerome Powell. Have a great weekend. Thanks for joining.